great about it because there is somebody who challenges. And I have seen audit committees, maybe about 3-4 years back, not anymore, where automatically some of the independent directors are even dozing off. They are not interested, they do not know financial reporting, they do not understand anything, and they even have the audacity to tell the auditor that you have got only 10 minutes to make a presentation, please do so, we have no time. So we have seen both the sides of the coin, but things are going to change because now there is a minimum qualification or prescription of qualification for the audit committee members. They are only the people now who will sit on the audit committee and not all others. And finally now, it is decided that the board will have 1/3 of the members as independent directors. Now friends, I know that you will think at this point of time that there was something separately in SEBI, there is something separately in Ministry of Corporate Affairs. What is it that we have to do? So currently, companies under the prescribed classes and listed entities are required to have 1/3 of the board as independent directors, which means that I remember earlier, if it was an executive chairman, then half of the board was required to be independent. And if it is a non-executive chairman, then it is 1/3 of the board required to be independent. But over here it says, irrespective of who the chairman is, 1/3 of the board has to be independent. And again, I believe the reason why 1/3 is becoming lesser than half. Why is it like that? It's because of the fact that today, you do not get good quality of independent directors. In the past, independent directors were subject to the same penalty and prosecution like any other director. So even I am aware of the fact that so many good independent directors resign and they do not even hold any directorship. They do not even want to come out and take more directorships. And therefore, Companies Act says now that only 1/3 of the board would be required to be independent. So when I talk about some other companies, they are generally companies which are public companies having a paid up capital of more than 100 crore. It's a paid up capital of more than 100 crore or the top line, the turnover of more than 300 crore. These are the companies, including the listed companies, who are required to have a woman director on the board, number one. And for a whole-time key managerial person or for a whole-time CEO or CFO, the requirement is that those are the companies which have a paid-up share capital of 10 crore or more. So look at it. Today, any small company also, which is a public company, with a paid-up capital of 10 crore, is required to have a CFO, a company secretary, and a managing director for running the affairs of the organization. These are the good steps in the right direction. Now, each of my slides will talk about the rules and will talk about the analysis of the rules. And I will accordingly sort of take you through. Having a woman director on the board is a welcome change because, again, it's not a gender biased board that everybody sitting on the board is a male. Now you have a combination of a male and a lady who will be sitting on the board. As I mentioned, they need not be independent. They can be a part of the executive board as well. Because today also, I have seen that there are very, very few women who are on the board of directors as independent directors. And they have actually exceeded the limits of 15 or 20. So you do not have enough women in the marketplace to become the independent directors. And therefore, the law says very clearly that somebody from within the organization who performs well can also be brought to the board of directors as an executive director and represent as a woman director on the board. The 182 days limit for a resident director, if you remember, I had mentioned that every company has to have at least one resident director. The good part over here is that the status of residence is exactly defined in a similar manner as being there under the Income Tax Act. So 182 days of presence for the resident director. However, now the companies are also required to have a mechanism in place to assess and monitor the expenditure incurred by the directors on foreign travel, because we all are aware of the fact that how lavishly that foreign travel can be, what kind of personal expenses can get debited to the company on account of the foreign travel. So they have made it mandatory now that if the directors are having a foreign travel, the remuneration committee or the board of directors also would take care of the fact that the reports of the foreign travel are properly reviewed. And if there is something that is personal out there, then it will have to be paid by that individual and not by the company. Another good move is that directors who resign will have to inform the ROC about the reasoning, about the reason why they have resigned, which is again good. Qualification of the audit committee members is a welcome change. However, all the companies cannot have all these things in place immediately. So wherever there is a requirement for an independent director, if at all you have to bring in an independent director, they will be given one particular year or one full year to comply with these requirements. Now we come to specifically independent directors. I wanted this session to be a little more detailed, and that's the reason why I'm going through step by step, because all of you are here to learn something different, to learn something which is new. And that's the reason I'm not talking at a very macro level. I'm going really at the micro level to make sure that you all fully understand what are the new provisions under the Companies Act. The definition of an independent director is now much more stricter. It prohibits any direct and indirect pecuniary relationship of a director with the company. So earlier, the director's relationship with people in relation to related party transactions and all were not being reviewed much. But now, all these things are reviewed, and only people with good academic record and who do not have any connection with the promoter or with anybody on the board will be appointed as an independent director. Anybody who is providing services to the company of a particular amount and beyond that amount cannot be considered to be an independent director because he has got his business interest in the company. So these are the things which are the new provisions in the Companies Act, again impacting good norms of governance in the right manner. Independent director has to be there for listed companies, which is the case, and it is also required to be there for some other kinds of companies, which I will tell you what those companies are. Independent director will be given 2 terms, each term of 5 years. Like in the case of an auditor as well, you have a period of 2 terms, 5 years plus 5 years. Similarly, in the case of independent director, there are 2 terms of 5 years plus 5 years. And then there is a cooling off period of 3 years, which means that he finishes 5 plus 5, there is a cooling off period of 3 years, and he comes back again after 3 years for another term of 5 years. However, just to mention that this particular section is not applicable from retrospective effect. This is applicable from prospective effect, which means that even our directors today, who may be sitting on the board for the last 15-20 years, will again have a term of 5 years plus 5 years. Now, this is something, to be very honest, and with due respect, as an individual, I would not appreciate, because many people who have finished 10-15 years should have been rotating out in the next 2-3 years to bring in fresh people as part of good governance. But when I was talking to somebody in the ministry, a very rational answer that came out was, as it is, the country is short of independent directors. If at all we ask these people to go and there are no other people to come up, it may result in a further shortage of independent directors. And therefore, this rule has become prospective, that 5 plus 5, then cooling off, and then another 5. In the case of auditors, it's different. I'm not touching about auditors right now, but in the case of auditors, it's different. In the next 3 years, if an auditor completes 10 years, then automatically from 2017, the audit firm will be rotating out. So that is a retrospective application. But in the case of directors, it's a prospective application. Another good point which came up for independent directors, and I'm sure that this will automatically bring in some good people again into the field of independent directors, is the fact that they are now protected, they are insulated from some liabilities. Earlier, independent directors were subject to the same liability and punishment like any other executive director. Now the independent directors would be punished only if at all they have been responsible for some of the omissions which has occurred with their knowledge and with their consent or connivance, which means that if they are forming part of the decision making, if they are aware that something is wrong, and if they have given their consent as well, or if they have been negligent in the performance of their duties, then they will be equally responsible. But if they were not forming part of the decision-making process, if they have specifically said that I am not voting for this particular decision, then they will be not punished for any wrongdoing of the other members of the board. So this automatically will bring in a lot of confidence again into the independent directors to come back as independent directors on the board. Now, which are the other public companies where you are required to have independent directors within a period of 1 year from April 2014? So we were talking about listed companies. Listed companies are automatically having independent directors, but now public limited companies with certain threshold will be required to have independent directors effective 1st April 2015. It gives you 1 year to appoint independent directors in such companies. And which are those companies? Share capital of 10 crore or turnover of more than 100 crore or the aggregate of outstanding loans and borrowings and deposits and everything exceeding 50 crore. Now today, more than 50% of the companies are falling under this category. So all these companies which are public limited companies and not listed will also have independent directors, minimum of 2 independent directors on the board effective 1st April 2015. When I'm putting the slide on the analysis, if I'm not covering certain points, don't get worried, I have already covered it, or it may not be very important. It's just how I analytically believe there is a change and there is a positivity in that particular arena. The good part which is coming over here is that independent directors are also appointed for a particular period of term. So it is 5 plus 5. It protects them in a way to continue for a period of 5 plus 5 years. And there is also a good amount of clarity on the fact that where they can be held responsible and where they cannot be held responsible. If somebody is proven guilty on account of his consent to be a part of the decision-making process which has gone wrong, then he will be responsible for that. But if he is not forming part of the decision-making, then he is not going to be responsible for that. Now we come to the number of directors and the directorships. In the case of directors in a company, the maximum number of directors has been increased to 15 from 12 because companies were required to have only 12 directors. Now the companies will have 15 directors. So maximum number of directors have increased to 15. In case if the company would want to have further directors or more number of directors, no problem. Large companies are required to have 20, 25 directors. Nobody can stop it. However, you are required to have an approval from the shareholders in the general meeting, and that through a special resolution, which means that majority of the shareholders will have to consent on the higher number of directors in a company beyond 15. The good part over here is that I'm really happy about the fact that all the protocols and all the formalities which were there in the past to go to the central government for the approval for increase in the directors and all has gone. You are not required to go to central government for any increase in the limits in the number of directors. No change in the minimum number of directors. The minimum number of directors remain the same. The increase limit can go up to 20. The maximum number of directorships. So for example, let's say that I'm a director in the company. I cannot be holding more than 15 as of today. Now the law has changed that if I'm a director in a company, an independent director in the company, from 15 I can take up 20 directorships as an individual. However, that 20 will include alternate directorships as well. So on one hand, they have increased the limit of my individual directorships, but at the same time they have included alternate directorships as well. And in the case of a company, which is not a listed company, but a public company, the directorship restricted to not more than 10. So public company directorship has been restricted to not more than 10. Now the increase in the limit of directors from 15 to 20 would enable independent directors with good record and experience to become independent directors on much more boards than before. And therefore, that would be a welcome change as well, because they can share their experience and their understanding and their professional expertise with more number of companies than what they were doing earlier. Let's go now to the disqualification of a director. Under what circumstances a director is disqualified? In case the director is convicted of any offense dealing with the related parties where he was a director, any time during the 5 preceding years, then he becomes automatically disqualified. So the simple way to analyze this is like, let's say I was a director on the board and I was convicted of an offense which was related to related party transactions. So that means there was something wrong, as a result of which I was convicted, I was punished. And that particular wrongdoing was some transaction between me and my related party in that company. And if I have been committed or I have been convicted, then for the next 5 years, I cannot take up any directorship. Now that's again a very good move. The Ministry of Corporate Affairs has designed to ensure that the directors do not commit any frauds, do not make profits out of related party transactions, and would ensure that the related party transactions would be at arm's length. The other good thing which came up also is the physical presence of the directors in board meetings. I have seen instances where a director may not even come for 1 or 2 board meetings out of the 5 or 6 or 8 board meetings in a year. Now the rule is that if a particular director has not attended any meeting in the last 12 months, he automatically becomes disqualified to be a director. Again, a good move. Not only in the case of listed companies or public companies, but there are certain restrictions of a director, and he may become disqualified or he may get disqualified from being a director in a private company also, in case if the financial statements or the annual return of that particular private company has not been filed for 3 continuous years. So let's say that I am a director in a private company and that company has not filed financial statements or annual return for the last 3 years. I have not played my role of a director in the manner in which I am required to play. I have not ensured good norms of governance, and therefore I have no right to continue as a director in that company. Second, if that company has failed to repay the deposits on time, or repay the debentures on time, or failure to pay the interest due, or even failure to pay the dividend which was declared, and such failure continues for a period of 1 year, automatically all the directors who are part of this private limited company would be disqualified. So friends over here, look at the kind of rigor the Companies Act is having even for private limited companies. We were all living in a different world, कि private limited company घर का है, कुछ भी हो सकता है, we can do anything and everything, but these are now covered very meticulously under the Companies Act, and individuals who are directors, who are promoters in private limited companies and who fail to ensure these things would automatically become disqualified or will get disqualified from being a director. So once again, it's my earnest request to all of you that we all work with so many private limited companies, we advise them, we give consultancy, we provide audit services. Please make sure that your clients are fully aware about these things. Else, a company will not have any director. It will automatically become a defunct company if the directors are disqualified. From an analysis perspective, I have covered the fact that provisions are becoming much more stringent now for private companies, public companies, and listed companies. It's going to bring in much more better discipline in the board of directors of all types of companies. Let's come now to the general body meeting and the board meeting of members. So there are 2 types of meeting: meeting of the board of directors and annual general meeting or extraordinary general meeting. And look at the way I'm comparing the 2 with the provisions of Companies Act 1956. Your first AGM in the past was required to be held within a period of 18 months from the date of incorporation of the company. Now the law has changed. It says that the first AGM should be held within 9 months from the closure of the financial year. So the very first financial year that you close, it could be 12 months, it could be 9 months, it could be 15 months, whatever. The AGM has to happen within a period of 9 months from the closure of the financial year. Not only that, a report on the AGM has to be filed with the ROC within 30 days of the conclusion of the AGM. So ROC has to get the report within 30 days. The other good thing is that every director who is on the board of directors will get a notice 7 days before the date of the board meeting. It's important to intimate the director well in advance so that he will block that particular day, he will be prepared for that board meeting, and he can come for that board meeting. So 7 days notice is mandatory. Minimum 4 board meetings in a year, which was the case earlier as well, and the gap between the 2 meetings should not be more than 120 days. And friends, please make sure that when it talks about days, you follow the days and not the months, because somebody will say, okay, fine, last meeting was on 31st March, next meeting can be on 31st July. But between 31st March and 31st July, it could be more than 122 days. Or it can be 121 days. So you have to go by the number of days and not by months itself. Again, a welcome change, which is definitely going to impact the cost of the company in a positive manner and the time and trouble to fly down for board meeting. Now the central government is allowing you to do a board meeting through video conferencing or through any audio-visual facility. It's not just audio, it's audio-visual. So you can do it through a video conference or you can do it through an audio-visual facility, provided that that particular audio-visual or video conferencing can be recorded and recognized. Which means that you can record a video conference, but if I am not seen in that video conference or if I am not recognized in the video conference, it will not hold good. So it's required to be recorded and recognized. However, the central government will prescribe some of the matters where video conferencing or audio-visual will not be allowed. Some of them have already been prescribed and some of them are yet to be prescribed. So which are the ones where video conferencing or audio-visual will not be allowed? Number one, when there is a meeting of the board of directors to approve the annual financial audited statements. So whenever there is an approval required on the audited financial statements, somebody cannot come on the video conference because the auditor's report is placed there. The auditor is sitting out there discussing the qualifications, discussing the issues. You are required to be physically present as a member of the board. You cannot be on the video conference, number one. Number two, approval of the board report. So wherever the board report has to be given, if the board report has to be approved, that individual also will be required to be there. Approval of the prospectus. Let's say that the company is going for a rights issue or an open offer or for anything which has to do with the market, prospectus. Every member of the board has to be physically present. Of course, he can be absent, but he cannot attend through a video conference. It's better for him to be absent then. His participation on the video conference will not be recognized. He will be treated as absent even if he is present on the video conference at that point of time. Audit committee meetings for consideration of accounts. Let's say I am a member of the audit committee and the accounts are to be approved on 31st March or 31st May or whenever. At that point of time, I have to be physically present in that place. If there is any meeting happening at the board level for any amalgamation or mergers or demergers or acquisitions or takeovers, these are important strategic decisions the board will be taking, as a result of which every particular board member has to be physically present. So under this scenario, every board member has to be present. His participation on the video conference will not be recognized. Now let's come to the very important one, audit committees. Now let me step back for 2 minutes and share my experience, because I have been talking only about the provisions. But let me share my experience of the audit committee. I am a hardcore auditor. I audit quite a few companies and I have been auditing this for the last 30 years. And times have changed for the better. For the companies, times are becoming difficult for the auditors. I cannot name the companies, but I can tell you that some of the very large names of our country and some of the multinational companies which are present in India, over the last few years in different businesses, I have audited them in the past when I used to work with a large accounting firm. And I really learned corporate governance not by reading, but by seeing what's happening in that audit committee. In 2002, I was auditing a very large Indian company, which is a very large multinational FMCG company. At that point of time, The audit committee was a new concept in India. But audit committee had 10 people. 10 people in the audit committee, of which 7 are independent directors. And these independent directors are who is who of this country. Mr. A, Mr. B, Mr. C. Absolutely well known. If I tell you all the 7 names, you will know all the 7 names. These are the people from where you learn what's governance. The internal auditor will come and make a presentation. He will be grilled for 3 hours. The statutory auditor is making a presentation. There will be discussions and deliberations for 2 hours with the statutory auditor. The CFO will be making a presentation on the performance of the company, financial highlights, at least for a couple of hours. And then there are people who are called from the various processes: distribution, supply chain, production, manufacturing, HR. And those people are making individual presentations to the audit committee. Look at it, 12 years back. That's called governance of the top order. Another large bank in India, a very, very private bank, but a very large bank. Audit committee goes on for 12 hours. Your lunch is there, your evening refreshments are there, you come out only at 9 p.m. in the night. That's the kind of rigor. Unfortunately, I cannot name those companies or banks. That's the kind of rigor. But what has happened in the past as well, as I mentioned earlier, it can be an audit committee which will get over in 15 minutes. And where I have walked out of that audit committee saying that if you believe that I am given only 10 minutes to come and make a comment, please ensure that next time we are not called for the presentation. If you want, you can appoint somebody else as an auditor, but we have serious concerns. If you will not allow me to speak in the audit committee, I will speak in the board. And I have done that. Even very recently, I have done that in one of the cases where the board was not the audit committee chairman felt that, he has limited time. Board meeting is going to start in the next 10 minutes. Sorry, you only have 5 minutes to make a presentation. So now it is up to the auditors as well to raise the bar and say very clearly that fine, I need some time. If you do not have the time, I'll go and make a presentation to the board. And trust me, auditors will be given great opportunity at the audit committee itself to make a detailed presentation. Because it is the audit committee chairman who will be taking the findings of the auditors to the board and presenting to the board where the qualifications are or where the concerns are. And if he is not giving time to the auditors, he himself will be failing in his own duty. So now coming back to audit committees, it's mandatory in the case of listed companies, and some other prescribed classes of companies will come to that as well. An audit committee should have a minimum of 3 directors, and independent directors should be a majority. So for example, let's say if audit committee has got 3 directors, then minimum 2 has to be independent directors. If the audit committee has got 7 directors, let's say there are audit committees with 6 or 7, then 4 members of the audit committee have to be independent directors. And look at the final one. It says the chairperson and the majority members of the audit committee should have the ability to read and understand the financial statements. Now, to be very honest, I'm very honest with you. There were some of the good provisions in the past which did not become the law of the land. It said that the audit committee chairman has to have financial literacy and a qualification as well. So he could be an MBA finance, he could be a chartered accountant. But over here, that's not mandatory. It says that the people who are in the audit committee and the chairman and all should have the ability to read and understand the financial statements, which means that he need not be a qualified chartered accountant or he need not be a qualified MBA in finance, but he should be able to read and understand the financial statements. Fine. I think that's okay.